Inventory valuation, full costing. In this chapter, we will look at how the matching principle can be extended to taking manufacturing overheads, which are incurred on a period basis, and transforming them into product costs, which we recognise when a sale is completed. We will look at the difference between variable costing, where only raw materials and direct product costs, for example, labour, are reflected in inventory valuations, and full costing, where inventory valuations include a portion of the manufacturing overheads indirect costs. We will look at the advantages of using full costing compared with variable. We will also look at how full costing profits can be affected not just from changes in the number of units sold, but also from changes in the number of units produced. And finally, we will look at how management can use full costing to manipulate reported profits in the short term. And formally, session aims. In this session, you will learn about an extension of the matching principle to the treatment of manufacturing overheads, and we will examine full costing and variable costing and intended learning outcomes for this lesson. Let's start off by reviewing costs. We can look at costs as being one of three types: as variable costs, variable manufacturing costs, manufacturing overhead fixed costs, and selling and admin expenses. So let's start off with variable costs. Variable costs can comprised of direct materials and direct labour. So direct materials and components become part of the finished products and are charged to individual jobs. And direct labour, this is wages and employment costs that are charged directly to particular products or particular jobs. And these are variable costs. Then we have manufacturing overheads. Manufacturing overheads are inherently fixed costs. So factory costs, all of the costs of operating the production facility that cannot be charged to individual products or customers directly, and that most or all product lines use to some extent. And examples of this include rent, insurance, property rates, utilities such as lighting and heating, machinery maintenance and depreciation of machinery. We've also got indirect labour. This is the cost of employing people such as supervisors and factory management that cannot be charged to a particular job or product. And there's also indirect material, items such as lubricants and cleaning materials, adhesives and other low-value materials that are not worth the time and trouble or cannot easily be charged to individual jobs or products. And away from the factory, we've got selling and admin expenses. These are the costs related to running the business. So salary of management and clerical staff, stationery, marketing and advertising expense, and head office expenses. What is variable costing? As work proceeds through the manufacturing process and labour is applied to it and other direct costs incurred, the value of an item recorded in inventory as an identifiable item, for example, an automobile in work in progress, increases. Under historic variable cost accounting, the value reflects all the variable direct costs expended to get the item to this stage. And here the variable direct costs comprise direct materials and components become part of the finished product and are charged to individual jobs, and direct labour, wages and other employment costs that are charged directly to particular costs. And what we will do is we will treat manufacturing overheads as period costs in exactly the same way as we treat overheads for the head office. The costs are recognised in the same period in which the benefits are received. And the underlying rationale here is that irrespective of production levels, these costs would be incurred anyway, and hence they should be charged against profits in the period in which the costs are incurred. And graphically we can see this. So direct variable cost for a job taken through as inventory value and then taken through at the time of a sale in cost of sales, while the indirect and fixed manufacturing overheads are taken through as a period cost during the period in which the costs were incurred. Let's do a recap of the inventory valuation equation. So we looked at this when we went through working capital components, and it's the same equation for most balance sheet items. So inventory value at the end of the period is equal to the value at the start of the period plus the cost of additions minus the cost of goods sold from inventory. But we can actually take this and rearrange it so that we get the product cost going through the cost of sales using the inventory valuation methods rather than counting the cost of individual items. Matching the cost of individual items against revenue does not consider wastage, losses from theft, accidental damage and spoilers. And if we do it that way, we'll probably overstate profits. And this is how profit for a period is actually calculated. So cost of sales is calculated this way. Inventory value at the end of the period minus the value at the start of the period plus additions. So we need to measure three items: the value at the end of the inventory at the end of the period, the value at the start of the period, plus the additions, rather than looking at the cost of the individual items sold. This is much easier to use and apply than trying to track the cost of individual units sold. So we only need to measure stock levels at the start of end of period and the value of new additions to the inventory. And this is known as the cost of goods or cost of goods sold or cost of sales equation. So let's look at an example to illustrate this application. So Solis & Co, specialist machine parts manufacturer. So each machine part has a selling price of 220 euros, variable cost of 30 euros each. And we are given the following unit sales and production figures for the first 3 months of a year. So January, February, March, we have a starting inventory at the beginning of January of 40. We add 150 units to inventory. We sell 150, so that's no net change. So the inventory at the end of the month is still 40. Starting inventory for February is the ending inventory for January is 40. Additions are 170, sales are 150, so an increase of 20 units, taking us to 60. And in March, 60 units in inventory at the start. Additions are 140, sales 10 units greater at 150, so inventory slipping to 50 units. So we're also told those 40 units at the start of January had an inventory valuation of 1,200 euros. So that's 30 euros each. And we're also told that the normal level of activity is a production level of 150 units a month. So January 150 and February, March slightly different. And we're also told that fixed production costs are expected to be 9,000 euros a month. And I'm going to assume for this example that the actual production costs are the same as those expected. So let's go through an application of cost of sales equation under variable costing. So that's just a summary of the data I just went through. So revenue, 150 units at 220 euros each month. So revenue each month is 33,000 euros. And if we start off with January, opening inventory 40 units at 30 euros each, so 1,200, plus 150 units addition times 30 euros each is 4,500. And then minus closing inventory of 40 units at 30 euros each. Product cost is 4,500. And those product costs reflect direct variable costs only. So we need to then add on to that the period overhead cost of 9,000 euros. So total cost of sales is 4,500 direct variable costs plus 9,000 euros period overhead costs. And then that gives us a gross profit of 33,000 euros, less 13,500 is 90,500. Move on to February. So February, number of units sold is unchanged at 150, but now we've got 170 units being produced. So closing inventory is up 20 units from 40 to 60. So our cost of sales equation is inventory at 1,200 euros, additions 170 times 30 is 5,100, less 1,800, which is 60 units at 30 euros each, which is our closing inventory, and product cost is 4,500. Unchanged period overhead cost, unchanged gross profit of 19,500. And in March, production has fallen to 140 units, and inventory, so revenue unchanged, number of units sold is 150. Inventory has fallen by 10 units because we only produce 140 units. So our cost of sales is 60 units opening inventory times 30 is 1,800, plus 140 units times 30 euros, which is our additions, is 4,200, less 50 units at 30 euros, which is 1,500. That's our closing inventory. Product cost 4,500, and again our period overhead cost of 9,000 euro, unchanged cost of sales, unchanged gross profit. The key under variable costing is that with the overhead being a period cost, that profit is only changes in profit are driven by changes in sales volumes only. They're not affected by changes in production volumes, and that is a key difference between variable costing and full costing, as we'll see. Let's move on then. So what is full costing? So under full costing, the underlying rationale is that the fixed manufacturing costs are product costs. This is really an extension of the accrual principle. And the accrual principle is that all related production costs should be matched in the period in which the sales take place. And so those fixed manufacturing overheads should be included in inventory valuations and then taken through cost of sales to arrive at a period profit. And full costing is the IFRS and US GAAP standard. So full costing, graphically, so we're taking the direct cost of the product, so variable proportion of fixed cost, which we can directly allocate to product lines, plus a fair share of the indirect cost of manufacturing overheads allocated to different product lines. And together, those give us the full cost of the product. And we can look at this graphically. So under full costing, the overhead costs of operating manufacturing, logistics and selling facilities are calculated on a time proportion basis, but then allocated on a product basis to work in progress and inventory, and only taken through the income statement when the finished goods are sold. So products produced in the period, overheads allocated to the products on some systematic basis, for example, labour hours, but in a capital intensive operation, it might be machine hours. I'm not going to talk about the different methods of allocating overheads to products. That's really a management accounting issue. Some systematic way. The key is that all of the overheads, all of the planned overheads are allocated to all the products being produced in a period. So here we've got two different product lines, product A and product B, and the overheads are split between these two different product lines, reflected in the valuations of the inventory. And so some of those units are taken through as cost of sales, and some of those costs are taken through as inventory. So those overhead costs which have been incurred, some of them have been taken through as cost of sales, but some of them, their recognition is being deferred, and they are carried forward on the balance sheet. And these costs will be recognised when these individual units are sold, rather than when the overhead costs are actually incurred. Historic cost for work in progress. So the value of work in progress on the balance sheet starts with raw material costs, and as it proceeds, we get a sort of snowball effect whereby the cost of other direct costs, for example, labour, raw materials, are accumulated as work progresses, and work in progress is also allocated a share of the overheads on its way to becoming finished goods. This method of allocation is sometimes referred to as the other way around, which is that units absorb a share of the overheads on their way to becoming finished goods. And the values for work in progress and finished goods on the balance sheet reflect the accumulated direct and indirect costs from the manufacturing process. And these deferred direct and indirect costs will be recognised when they're matched against the revenue from selling the finished goods. So you can see this as an extension of the accrual principle. Number of different overhead allocation methods. I said I wouldn't spend a lot of time on this. So these overheads will be allocated to products and jobs. Direct labour hours is the most common basis. And the rationale for that is that larger jobs generally require more labour hours, so it would seem equitable to give more overheads to larger jobs. Many overheads are related to time, rent, heating, lighting, depreciation, management salaries, and it's relatively easy through timesheets and other means to measure labour spent on individual units. But there are other methods which may be used, so capital intensive machine use or machine hour for a warehousing operation per square metre of space used. The key with any of these methods is that all of the overheads need to be allocated to products in the period in which the overheads were incurred. So let's look at overhead absorption rates based on labour hours. So we can define an overhead absorption rate per hour charged to individual jobs as being total overheads divided by total labour hours in a period. And we can also calculate an absorption rate per unit. And this we can arrive at this by total overheads during a period divided by total planned production in units during the same period. And then the full cost per unit is given by the overhead absorption rate per unit. So that's total overheads divided by total planned production plus variable cost per unit. And provided we're selling each unit at a price greater than the full cost per unit, then we should be making a gross profit. Let's look at our example of Sillies again, but this time with same base case, but we'll apply full costing rather than variable costing. So just remind overheads 9,000 euros a month, planned production 150 units, and the variable cost per unit is 30 units. So we'll start off by working out the absorption rate per unit, and that's our total overhead of 9,000 euros per month divided by planned production of 150 units per month. So 9,000 divided by 150 gives us an absorption rate per unit of 60 euros, plus the variable cost per unit of 30 euros gives us a full cost per unit of 90 euros. And that is the cost that we will be applying when it comes to inventory valuation. So let's look at our example for Sillies again for January. And that's just a reminder at the bottom. Variable cost per unit is 30 euros, overheads per month is 9,000 euros, and our full cost per unit is 90 euros, planned output per month is 150. And that's a treatment under variable costing. So revenue is 33,000, and then our product cost based on variable direct costs, and then we've got period overheads and gross profit 19,500 euros. Full costing, the revenue will be exactly the same under full costing, 150 units sold at $220 each. The accounting treatment of the cost does not affect the revenue, of course. But now our cost per unit is 90 euros rather than 30. So our starting inventory is 40 units at 90 euros is 3,600. 150 units addition times 90 euros is 13,500. And we've got 40 units at 90 euros is our closing inventory. So 3,600 plus 13,500 minus 5,400. Our product cost is 13,500. There are no period overheads because all of our overhead costs have been allocated to inventory, and our gross profit is unchanged. So the gross profit that's been reported is the same. We have produced the same number that we have sold. And in this specific example, where the planned output is the same as the actual output, we'll get the same profit figure for variable costing as we get for full costing, assuming that the sales is the same. So let's move on to February. So key difference in January, the number of units sold is unchanged, but the number of units produced is 170 versus the planned production of 150. So there's an increase in the inventory at the end of the period from 40 to 60. So full costing revenue is the same, 33,000 euros. Opening inventory, 40 units at 90 euros each, 3,600. And then we've got additions, 170 units at 90 euros each, which is 13,500. Less closing inventory of 5,400, which is 60 units times 90, that's 13,500. That is also 150 times 90 euros per unit, which is what we'd expect because that's the number we sold and that's being matched against the revenue. No period overhead costs and unchanged gross profit. We have a problem, and the problem is this. The 170 units that we have added to our cost of our product costs includes overheads of 60 euros per unit. So the total overheads which have been reflected in that cost, those product costs, are 170 units at 60 euros each, is 10,200 euros. But, and this is the key, we have only incurred costs of 9,000 euros during the period of manufacturing overheads. So in effect, we have effectively capitalized 1,200 in overhead expenses that the firm did not incur during the period in which we will recognize in a later period. And this means that the expenses are overstated and the profit is understated. How does IFRS treat it? An over-recovery? Well, first of all, an over-recovery of overhead occurs when the firm makes more units than the number it planned and used to calculate the absorption rate. And this results in expenses being overstated and profits understated. So we can define this, or we can calculate the over-recovery of overheads in monetary terms as the actual production in units minus the planned production in units times the absorption rate per unit gives us the over-recovery of overheads. And the IFRS treatment is to reverse this over-recovery in the period in which the over-recovery takes place. So let's look at how that's done. So February again, variable costing unchanged, and full costing we will keep our product cost exactly the same as we had before, but now we will reverse this over-recovery. So the number of products produced greater than the planned number is 20 at 60 euros each. The over-recovery is 1,200. We want to reverse this, and the effect of this is to lower cost of sales, and it will reduce the cost of sales from 13,500 by 1,200, take cost of sales to 12,300, and increase in the gross profit for the period to 20,700 euros. Let's move on to March. March has a different problem. So that's the treatment under variable costing, and under full costing revenue is unchanged. But now we're only producing 140 units, so we're producing 10 units fewer than we planned to produce. The product cost is unchanged at 13,500, which comes at 60 units at 90 euros each, going 5,400. 140 times 90, which is the additions, is 12,600. Less closing inventory is 50 units times 90 euros, 4,500, gives us product cost of 13,500. No period cost because full costing incorporates that into inventory valuations. And the problem here is that the valuation of the 140 units added to inventory is taking into product cost overheads of 60 units, 60 euros per unit. So we've got 140 units at 60 euros. That gives us 8,400. But the firm actually incurred costs of 9,000 euros. So what's happened here is the opposite to what happened in February, which is that we failed to recognize 600 euros in overhead expenses that the firm actually incurred during the period. So here the profit is overstated. And the IFRS treatment of under-recoveries. So just a reminder, so under-recovery of overheads occurs when the firm makes fewer units than the number planned it and used to calculate the absorption rate. And it results in expenses being understated and profit overstated. And we can calculate under-recovery of overheads as planned production in units minus actual production in units times the absorption rate per unit. And the IFRS treatment, to be consistent, is to reverse the under-recovery in the period in which the under-recovery takes place. So we'll go through March with the reversal of this under-recovery. So our revenue unchanged, our product costs unchanged, and now we've got this under-recovery of reversal of the under-recovery 10 units at 60 euros each, or 600, and this will have the effect of increasing the cost of sales, because we're adding back these expenses which we have missed, and that will reduce the profit. So that takes it down from 19,500 to 18,900 euros. So higher total cost of sales and lower profit. And so this is one of the key differences between variable and full costing, is that under variable costing, profit is a function of changes in sales only, while under full costing, changes in profit are a function of sales and production levels. And I've just put this in a tabular form. So if the actual production is less than planned, variable costing will always give the higher profit at any sales volume. And the reason for that is because of the reversal of the under recovery. And if the actual production is greater than planned, full costing will always give the higher profit, and that is due to the reversal of the over recovery. When actual production is the same as planned, if sales is greater than actual production, variable costing gives a higher profit, and that's because under variable costing we're only taking the period costs for that period through, whilst under full costing we're taking through some manufacturing overheads from earlier periods through as product cost during the period of the sales. If sales equals actual production and actual production is the same as planned, then we'll give the same profit. And if actual production is the same as planned, but sales is less than actual production, then full costing will give the higher profit. And that's because only a portion of the manufacturing overheads for that period have been taken through under full costing, while all of the costs have been taken through under variable costing. Some advantages and disadvantages of full costing compared to marginal or variable costing. So advantages, it's an extension of the matching principle. So there is a solid theoretical justification. And this is the IFRS and US GAAP reporting standard. And if we look at this from a pricing point of view, a firm needs to include all product costs to be able to tell whether a product's being sold at a profit or not. And the inventory valuations reflect full production costs and not just the variable costs. Disadvantages, there is a management systems overhead in terms of applying this, and period profits vary with both sales volumes and production volumes, which makes variations in profits harder to understand intuitively. And it also provides management a method for short-term profit manipulation. And they can do so by increasing production to create a situation where there's a reversal of an over recovery, giving a short-term inflation to profit. And full costing is not used as a short-term management accounting tool, largely because it's difficult to change fixed cost overheads quickly. And management accounting, when it comes to short-term changes, focuses much more on the direct variables. And advantages and disadvantage of variable costing. So it's simpler to apply, and it's easier to understand changes in profits. So period profits vary with sales volumes only, which makes variations in profits easier to understand. And it is used more as a short-term management accounting tool. It's much easier to change variable costs short-term than long-term fixed overheads. Disadvantages: variable costing as an accounting method is only used for small firms under IFRS, and it's against the spirit of the matching principle. And inventory valuations are understated; they don't reflect all product costs, and it may be that it encourages the sale at prices that give a marginal profit, but result in a loss when all production overheads are taken into account. So in this session, we've looked at this extension of the matching principle to the treatment of manufacturing overheads. We looked at full costing and variable costing, the treatment under full costing of over and under recovery, and advantages and disadvantages of variable and full costing.